Yes, everyone. Very good morning, everyone. How are you all? Let me know, is the voice audible? Yes, sir. So, today in this particular revision lecture, we'll take AS11, the effect of changes in foreign exchange rate for CA Inter Advanced Accounting paper. Let us start a revision. So, in this chapter, there are actually three topics. AS11 deals with three particular topics. One is the accounting for foreign currency transaction. Second is the translation of financial statement for foreign operation. And the last one is forward exchange contract. Normally all these topics are important from examination point of view. So first let us start with the foreign currency transaction. So what are foreign currency transaction? Any transaction which is denominated in foreign currency are foreign currency transaction. Foreign currency are any currency other than reporting currency. So of course in India the financial statement is prepared in Indian currency. So any currency other than Indian currency will be foreign currency. So if you have done any transaction in foreign currency, that will become a foreign currency transaction. One thing is clear, that even though the transaction has been done in foreign currency, but can I say we need to record that transaction in Indian currency. So how to translate that foreign currency transaction in from foreign currency to Indian currency, that we need to understand. For that purpose, what AS11 says, that recognition of foreign currency transaction, we are doing this topic. So for that purpose, initial recognition, whenever whenever the whenever we do initial recognition for that particular transaction, the translation will be done based on a transaction rate, exchange rate or average rate. Means as per the information given in the question. Normally for a particular question, transaction rate, exchange rate might be given or average rate might be given. Whatever is given, we will apply that. Got this point? So exchange rate on the date of transaction or average rate or average rate. So that initial recognition will be done at which rate? Transaction rate, exchange rate or average rate. Now for subsequent recognition means what? Either on settlement, either on settlement date or on balance sheet date, or on balance sheet date. For example, you have done one credit transaction for sale and you have done one journal entry debtor account debit to sales, and if the amount is collected before balance sheet date, then can is settlement date will come before balance sheet date. But if the amount is collected after balance sheet date, then settlement date will come after balance sheet date. In that case, can I say, in that case we need to understand how to translate that transaction, means how to do translation in balance sheet date as well as on settlement date. So subsequent recognition means translation on balance sheet date or settlement date. That depends upon whether the item of balance sheet, means item of assets and liability, are foreign currency monetary item or foreign currency non-monetary item. So if it is foreign currency monetary item, now sir, what is foreign currency monetary item? Of course we'll discuss that. But what AS11 says, that if it is foreign currency monetary item, then translation will be done at closing exchange rate. Means whatever the closing exchange rate is prevailing for that particular date, that rate will be used for translating that foreign currency monetary item. So foreign currency monetary item will be translated by using closing exchange rate. Now if it is foreign currency non-monetary item, and if that item is carried at cost, correct, so if that item is carried at cost, then no need of translation. Means we can say that it will be translated by using the initial transaction rate, exchange rate or average rate. Means it will be translated by using this rate only, therefore it means no need of translation. There is no need of translation. Then exchange rate on the date of transaction will be only taken into consideration. But if that foreign currency non-monetary item is carried fair value, for example, suppose you have property, plant and equipment, that is a foreign currency non-monetary item, and for that if you have opted for revaluation model, so of course it is carried at fair value. In that case it will be translated at exchange rate on the date when the fair value is determined. So at exchange rate when the fair value is determined. Got this point? This is the rule for translation. So can I repeat once again? For foreign currency transaction, for initial recognition, translation will be done at transaction rate, exchange rate or average rate as per the information given in the question. Subsequent recognition, if it is foreign currency monetary item, translation will be done at closing exchange rate. If it is foreign currency non-monetary item and if it is carried at cost price, then no translation required, means it will be translated by using the exchange rate which has been used for initial transaction date, initial recognition, which has been used for initial recognition. But if it is carried fair value, then we need to translate at exchange rate when the fair value has been determined. Got this point? Yes, sir. Now, due to this translation, if there is any exchange difference, correct now. So, of course, treatment of exchange difference we need to understand. So, due to translation, if there is any exchange difference, that exchange difference will be transferred to profit and loss account. So, exchange difference on settlement of foreign currency monetary item or on translation of foreign currency monetary item are recognized in PL. Got this point? Let me take one question. Then I will come to the meaning of what foreign currency monetary item. Question number 2, goods purchased on 1/1/2007 of US dollar 10,000. At that time the rate was 45 rupees per dollar. So what will be journal entry? What journal entry will do? Batao. What journal entry will do? A minute. Then our journal entry will be at purchase account debit to payable. So what was the date? Date was goods was purchased on 1/1/2007. So on 1/1/2007 will pass one journal entry, purchase account debit to payable, and it was purchased at $10,000. So $10,000 multiply by what is the rate? 45. Will do multiply by 45. So it will come 4,50,000. 4,50,000. Understood? Correct. Then of course year end will come 31st March 2007. So this payable is a foreign currency monetary item. So this will be translated by using closing exchange rate. So what happened on 31st March 2007? Let's see. The exchange rate on 31st March 2007 was 44. So your liability will decrease, therefore there is an exchange gain. So what journal entry you will do? Because it was initially recorded at 45, now the rate become 44. So payable to exchange gain will do exchange gain, and this exchange gain will be transferred to profit and loss account. So we'll do 10,000 multiplied by 45 minus 44. So that is rupees 1. So that become exchange gain 10,000. And of course your liability will now become 4,40,000. Now on settlement date they have given date of actual payment is 7/7/2007. On that date it become 43. Means actual payment will be made at rupees 43. So on 7/7/2007, what journal entry will do? Payable will be settled. So the initial liability whatever we have recorded on 31st March is 4,40,000. But now we'll do payment based on 43. So 10,000 into 43, that is 4,30,000. Again there is an exchange gain. So to exchange gain, this exchange gain will be transferred to what? Profit and loss account. How much exchange gain? Again exchange gain is of rupees 10,000. Got this point? Have you understood? So this will be the journal entry. I hope you have understood this point. Any doubt? No doubt? Yes sir. Now coming to the meaning of foreign currency monetary item and foreign currency non-monetary item. Foreign currency monetary item and foreign currency non-monetary item. In simple word I will say any receivable, any payable in cash, or I will say in currency. Understood? That will be foreign currency monetary item. Means if you have some receivable or payable that is going to be settled in currency, whether it is Indian currency or foreign currency, that become monetary item. If it is settled in foreign currency, then it become foreign currency monetary item. Got this point? So suppose you have a debtor which will be settled in Indian currency, so that become what? Domestic. That become what? A monetary item, but that is not a foreign currency monetary item. But that debtor will be settled in foreign currency, so that become foreign currency monetary item. So what do you mean by foreign currency monetary item? These are money held and assets and liability. So these are money held. It is held in the form of money which is to be receivable or payable in money, correct? An asset and liability to be received or paid, to be received or paid in fixed or determinable amount of money, in fixed or determinable amount of money, so that become foreign currency monetary item, correct? So in simple word I will say any receivable, any payable which are to be settled in currency. Currency means either in cash or through checks. The amount to be received in cash or checks, or amount to be paid in cash or checks, then it will become what? A foreign currency monetary item. And if it is to be settled in foreign currency, then it will become foreign currency monetary item. Understood? So can you repeat with me? Monetary item are money held, assets and liability to be received or paid in the fixed or determinable amount of money. What are non-monetary item? Which are not monetary item, that will become non-monetary item. For example, cash at bank will be monetary item. Cash in hand will be always monetary item. Bank loan, can you say payable in cash only? So payable in money, money form. So it will be what? Monetary item. Monetary item. Fixed deposit, monetary item. Debentures, of course, monetary item. Expense payable, it is also paid, will be paid in cash, means money, monetary item. Prepaid expense, now prepaid expense asset which will be settled only by delivery, means it is an asset, so the benefit received by delivery of what? Goods or services, means we receive some goods or services, so this become non-monetary item. Non-monetary item, because here it will be received, the expense will be this asset received in some goods or services. We are not going to receive any cash, therefore it become non-monetary item. Got this point? Redemption, redeemable preference share capital, of course it is also to be settled in money only, so it is a monetary item. But equity share capital, can I say equity share capital will not be settled in money, therefore it will be a non-monetary item. Non-monetary item. See, investment debenture monetary item, but investment in equity shares will be a non-monetary item. Non-monetary item. Got this point? Yes, sir. Inventory, there is a lot of confusion about inventory. Inventory is also not money held. When it will be sold, then money is going to be received. So inventory is also what? Non-monetary item. Non-monetary item. PP is non-monetary item. Intangible asset is non-monetary item. Investment property is non-monetary item. Advance from customer means you have given some advance, you have given some, you have received some advance from customer. So if you have received some advance from customer, can you say it will be settled only by delivery of goods or services? So this is also non-monetary item. Now advance to supply, if you have given some advance to your supply, so you are going to receive some goods or services, therefore it is also a non-monetary item. Non-monetary item. So they may ask one question that whether it is monetary or non-monetary. In MCQs this type of question can be asked. I hope you have understood. In simple word I will say any receivable or payable which are to be settled in money, then this will become monetary item. Got this point? So now I hope you have understood. For subsequent recognition, if it is foreign currency monetary item, because they are going to be received or to be settled in cash, so therefore it will be recorded at what? Closing exchange rate. But non-monetary item are not going to be received or settled in cash, therefore if it is carried cost, then no translation is required. But if it is carried at fair value, then we'll use the exchange rate when the fair value was determined. Got this point? Yes sir. Chalega. Now this is one para 46A of AS11. Para 46 of A 46A of AS11, that gives some exception to the above rule. I mean right now what we have done, that any exchange difference will be transferred to profit and loss account, but in this para 46A of AS11 they have given some option to the entity. Means that option has been given to the entity, but if that option is exercised, then they need to continue the same policy throughout the year. Throughout the year means throughout the life. They cannot again change the option. So what is that option? Just try to understand what para 46A says. para 46A of AS11. So there is an option. The option has been given. Option is only available for long-term foreign currency monetary item. Means for short-term foreign currency monetary item, there is no such option, and any exchange difference on short-term foreign currency monetary item will be always transferred to PL. But if there is a long-term foreign currency monetary item, so there is an option given कि either exchange difference can be transferred to PL, exchange difference can be transferred to PL, or exchange difference can be capitalized. Exchange difference can be capitalized. So this option has been given. But if this option is exercised, means the option for capitalization is exercised, they need to continue such option throughout the company's life. Means they cannot again change the option. Understood? Now what this says that in this case, how to do the capitalization? Well, if foreign currency monetary item, means long term foreign currency monetary item is used for acquisition or construction of a depreciable asset, means it is used for either acquisition or construction of depreciable asset. Understood? Then this exchange difference will be capitalized. Exchange difference will be capitalized to the cost price of depreciable asset. Correct? So if the foreign currency monetary item is used for the acquisition or construction of depreciable asset, then exchange difference of foreign currency monetary item will be capitalized to the cost price of depreciable asset. Means if there is an exchange loss, it will be added. If there is an exchange gain, it will be deducted from the cost price of depreciable asset. But if it is for any other purpose means it is not used for the acquisition or construction of a depreciable asset, for any other purpose, then this exchange difference will be accumulated in a special account, and that special account is known as FCMITD account, foreign currency monetary item translation difference account, FCMITD account. So this exchange difference will be accumulated in a special account known as FCMITD account, and this will be amortized to PL during the life of foreign currency monetary item. Suppose you have taken loan for some other purpose, you have taken a foreign loan for some other purpose, so exchange difference because of that loan will be transferred to FCMITD account, and that will be amortized to PL during the life of the loan. So this option has been given in para 46A. Understood? Let us read what they have given. So it is an option to the entity, and such option is irrevocable. That is, once exercised, should continue with the same. This para is not applicable for short-term foreign currency monetary item. It means any foreign exchange difference arising from such monetary item, means short-term foreign currency monetary item, will be transferred to PL account only. Option available to entity for long-term foreign currency monetary item. If long-term foreign currency monetary item related to acquisition of a depreciable asset, so any foreign exchange difference arising from such monetary item can be added or deducted from the cost price of asset and shall be depreciated over the remaining useful life of the asset. चलेगा? तो shall be added to exchange loss will be added, shall be deducted means exchange gain will be deducted. If long-term foreign currency monetary item is not related to acquisition of a depreciable asset, then any foreign exchange difference arising from such monetary item can be accumulated in which account? What I have said, foreign currency monetary item translation difference account. We call it FCMITD account in the entity's finance statement, and amortize over the balance period of such long-term asset or liability, long-term foreign currency monetary item. So it will be amortized during the life of that foreign currency monetary item. This is the concept. Let me take one question based on this. Come to one question number 9. A Limited has borrowed $10,000 in foreign currency on April 1, 2001 at 5% per annum annual interest and acquired a depreciable asset. The exchange rate are as under. On 1/4 it is 48, on 31st March it becomes 51. You are required to pass journal entry in the following cases. Option under para 46A is not available. Well, if the option is not available, so we are doing question number. Okay, understood. So we are doing question number 9, point number A. कि para 46A is not available. बताओ, you have taken a loan on which date? On 1/4/2001. On 1/4/2001, what journal entry you'll do? Bank account debit to foreign loan. Foreign loan. What amount you have taken? That is $10,000. $10,000. At that point of time, what was the exchange rate? It was 48. So you'll do at transaction reduction rate, that is 4,80,000. 4,80,000. Then on 31st March 2002, interest will be there. Interest at the rate of 5%. So what journal entry you'll do? कि भाई interest expense, or you can say finance expense, account debit, and let us assume it is paid. Nothing is given, we'll assume it is paid to bank. So that will be 10,000 into 5%. 5%. And can I say payment will be done based on 51. 51 is the exchange rate on that date, or 10,000 into 5% into 51, that is coming 25,500. So 25,500 will come. Understood? Now on that date, this foreign loan is what? One type of foreign currency monetary item need to be translated by using closing exchange rate. Now the rate become 51, so your liability will increase, and there is an exchange loss. So you will say exchange loss, account debit to what? To foreign loan. Your liability will increase by what amount? 10,000. So it now become 51. So 51 minus 48 means 3. So your exchange loss will be 30,000. Your exchange loss will be 30,000. Now if the para, just write on, if the para 46A is not available, so this will be transferred to PL. So we'll pass one journal entry, PL account debit to exchange loss. Exchange loss. So we'll say 30,000 will be transferred to PL. But if the para second point option under para 46A is available, then this journal entry, this journal entry, this journal entry remains same. Only this last journal entry will change. So or what? If the para 46A is available, then we'll say exchange loss will be capitalized, and we'll say PP account debit to what? Exchange loss. Exchange loss, and this will be capitalized to property, plant and equipment. You will pass only this one more journal entry, means the last journal entry will change. The last journal entry will change. And the third option what they have given, the loan was taken to finance the operation of the entity and not to purchase depreciable asset. In that case, this exchange loss will be accumulated to FCMITD account. So we will pass one journal entry. What journal entry? FCMITD account to exchange loss. FCMITD account to exchange difference या exchange loss account. So the first three journal entry remain same. Only exchange loss will be transferred to PL. या exchange loss will be capitalized to the cost price of property, plant and equipment, or exchange loss will be accumulated in FCMITD account. That we need to understand. So you can see in all cases they have done the three first journal entries same, and you can see they have changed only what last account, last journal entry, that PP account debit to foreign exchange difference account, and here foreign currency monetary item translation difference account to foreign exchange difference account. Foreign exchange difference account means exchange loss account. You can also write on exchange difference account. Chalega? Yes sir. So this type of question can be asked. Got this point? I hope you have understood this point. So this is very important from exam point of view. Important from exam point of view. Correct? Yes sir. Now come to next point. Foreign operation. Now foreign operation actually it will be also covered in one chapter, that is branch. In that we have will do foreign branch. So whenever there is a foreign operation, the foreign operation means it can be in the form of subsidiary or associate or joint venture branch of the reporting entity. Means any foreign subsidiaries, any foreign associate, any foreign joint venture, any foreign branch of foreign operation. Correct? The activities of which are conducted in a country other than the country of reporting entity, means the head office, या parent company or investor will be in in India, but this foreign operation will be in a country other than the India. Okay. Now for translation of the financial statement of foreign operation, the foreign operation are of two types. Types of foreign operation: integral foreign operation or non-integral foreign operation. Means of course can I say, when we have a foreign operation, so we will prepare a trial balance in foreign currency. Now we require consolidation because if the parent company has a foreign subsidiary, the consolidation required. So trial, then the financial statement of foreign operation need to be translated as per Indian currency. So how to do that translation, that we are discussing for consolidation purpose. So for that purpose, all the foreign operation are two type: integral and non-integral foreign operation. In simple words say, integral foreign operation are those foreign operations which are dependent on Indian reporting entity, and if they are independent from Indian reporting entity, then that will be non-integral foreign operation. In simple word, got this point? चलेगा? Have you understood? Yes, sir. So integral foreign operation meaning wise is what? Integral foreign operation are those foreign operations the activities of which are integral part of those of reporting entity, means their activities are as simple as the activities of reporting entity. So these are that are integral part of reporting entity. Correct? So integral foreign operation which is carried out as if that were an extension of the reporting entity operation, like dependent branch or any sales depot, etc. So in that case, if there is an integral foreign operation, so what is the translation rule? So if there is an integral foreign operation, what is the translation rule that we are going to understand? So what they say, all the non-monetary item. So non-monetary item, now you have understood. For example, it is what? Property, plant and equipment, intangible asset, etc. If they are carried at cost, then use transaction rate exchange rate. If they are carried fair value, then use revaluation date exchange rate. However, if question is silent, always use the transaction rate exchange rate, because if the question is silent means it is carried at cost only. Correct? So non-monetary item, if they are carried at cost, then use transaction date exchange rate, means when you have purchased it, at that time what was the exchange rate. Correct? If the question is silent, use what? Transaction date exchange rate. Accumulated depreciation or depreciation, so we should use the rate used for the translation of non-monetary item. So rate used for the translation of fixed asset, whatever rate you have used यहाँ पर, that rate will be used for the accumulated depreciation and depreciation. Correct? Any monetary item, now you know monetary item, so all the monetary item will be translated by using closing exchange rate. Closing exchange rate. All the revenue item, means all the income and expense, will be translated by using either transaction rate exchange rate or average rate. So either actual transaction rate or average rate. Of course in exam they will give you average rate, so that will be translated by using average rate. चलेगा? Opening stock means last year closing stock, the opening stock will be translated by using opening rate. However, closing stock, okay, closing stock means inventory also non-monetary item. If they are carried at cost, then you will translate by using transaction rate exchange rate. But if it is carried at NRV, then by using closing exchange rate. So if the question is silent, we'll use closing exchange rate. Be careful in exam. For inventory, normally questions are silent. So from exam point of view, we'll assume it is carried at NRV and we'll convert by using closing exchange rate from examination point of view. Now any difference in this translation will be exchange difference, and that exchange difference will be transferred to profit and loss account. So for EFO, the rule is very simple. Whatever rules we have applied for foreign currency transaction, that same rule has been applied. So can you repeat with me? Any non-monetary item means property, plant and equipment, intangible asset. If carried at cost, it will be translated by using transaction rate exchange rate. If carried at fair value, then revaluation rate exchange rate. For depreciation and accumulated depreciation, use the rate which has been used for the property, plant and equipment and intangible asset. For monetary item, use closing exchange rate. For any item of income and expense, will use uh, either transaction rate, exchange rate or average rate as per the information given in the question. However, in exam they will give you average rate only. For opening stock, will use opening rate. For closing stock, will use if carried at cost then at transaction rate, exchange rate. But if carried at NRB, then at closing exchange rate. From exam point of view, question is silent. For closing stock, will use what? Closing exchange rate. Any difference due to this translation will be transferred to exchange difference, which is ultimately transferred to profit and loss account. If the question is silent, then always assume foreign operation is EFO. EFO means integral foreign operation. Chalega. Let me take one question. However, same will do where? In foreign branch chapter also. Come to one question. What is given? A business having a head office in Kolkata has a branch in UK. The following is the trial balance of branch as on 31st March 2004. You can see all the amount is given in what? All the amount is given in what? Pound. Great Britain pound. चलेगा. UK तो this is pound. तो machinery purchase on 1/4/2001. तो 1/4/2001 what is the rate given? Check करो. तो on 1/4/2001 the rate was 61. Understood? The rate was 61. On 1/4/2003 means opening was how much? 63. 31st March 2007 closing is what? 67. Correct? Understood? These are the rate given. So average is not given, so we can find out average rate. Average rate will be 63 plus 67 divided by 2. So opening plus closing divided by 2, how much it is coming? 65. So average will be 65. Average will be 65. Correct? So what will take? So machinery, because it was purchased on what? Purchase on 1/4/2001. So for machinery will multiply by 61. देखो 5000 into 61. 5000 into 61 is coming how much? 3,05,000. चलेगा. Debtor, because it is a monetary item, will use closing rate into 67. Check करो. 1600 into 67. It will be 1,07,200. Opening will take opening rate, that is 63. Good received from head office. Normally the Indian currency will be given, the equivalent Indian currency. So good received from head office, you can see receive in head office account rupees 4,02,000. Therefore translation is not required because we know the actual in Indian currency. So for this you can see will take actual. Sales will use average rate. Average. So 20,000 into will do 65. Check karo. So 20,000 into 65, how much it is coming? That is 13 lakh. Purchase average rate, wages average rate, salaries average rate, cash closing rate 67. Remittance to head office also what will be given? The remittance to head office you can see recorded in HO books at rupees 1,91,000. Therefore, if you know actual, no translation required. Similarly, HO account, you can see they have given HO account in Indian currency, it is 4,90,000 because we know the actual, therefore no translation required. Creditor once again at closing rate 67. Exchange difference, of course, what is the difference coming? That will be transferred as a balancing figure. Exchange difference 20,200. So you make the total of debit, total of credit, the difference will be transferred to either debit balance or credit balance. So of course here the total of credit is more than total of debit, so difference is coming in debit side. So we have an exchange loss of 20,200. 20,200 chalega. Yes sir, correct. Now you can see they have given closing stock outside the trial balance. So whatever coming outside the trial balance, correct, now that you record outside the trial balance only, but this will be translated by using closing rate, that is 67. Depreciation at a rate of 10%. Depreciation we can calculate. Depreciation will be 500, but will be translated by using what? The rate which is used for machinery. So it will be by using 61 only. Check karo, they have given closing stock 700 into 67, how much? 700 into 67, that is 46,900, and depreciation into 61, so 500 into 61, how much? That is coming 30,500. Means rate used for fixed asset will be used. Chalega. But any item which is given after outside trial balance will be incorporate outside trial balance only, that you don't incorporate in the trial balance. Chalega? Yes sir, this also you have understood. Now for non-integral foreign operation, so one thing we have understood, any foreign operation which are not integral are called as, are known as what, non-integral foreign operation. So already I have said, if any foreign operation are independent, they do not require the dependency of foreign of Indian reporting entity, therefore they are what, non-integral foreign operation. They have given some indicator of NIFO. So there are some indicator which will indicate that given foreign operations are NIFO. NIFO means non-integral foreign operation. What are the indicator? Foreign operation are carried independently without much dependence on reporting entity, means they carried all the activities independently. There are very few transactions with the reporting entity with no much dependency is there. Foreign operation raises their finance independently, means they do not require support of Indian reporting entity. There is an active local sales market for the foreign operation product, therefore they do not want any help from what, Indian reporting entity. All the expenses of foreign operation product or services are primarily paid or settled in the local currency rather than in the reporting currency, means they can settle all their expenses in their own currency. They do not require support from Indian reporting entity. It means there is no much dependency and therefore they are non-integral foreign operation. Chalega? Now for them rule is very simple, कि all asset and all liability, whether it is monetary, non-monetary, now there is no concept of monetary, non-monetary in this case. All asset, all liability, all asset, all liability, whether monetary, non-monetary, will be translated by using closing exchange rate. All income and expense will be translated by using transaction rate, exchange rate or average rate, either exchange rate at a rate of transaction or average rate. Equity will be translated by using the transaction rate, exchange rate. So when the equity shares were issued, at that time what was the exchange rate prevailing, at that rate it will be translated. Understood? So for equity it is transaction rate, exchange rate. The rule is very simple, all asset, all liability at closing date, all income and all expense, of course average rate will be given to average rate, equity based on the transaction rate, exchange rate. Now any difference in the trial balance or the balance sheet will not be transferred to PL. The difference will be accumulated in a separate account known as foreign currency translation reserve account. So all resulting exchange difference should be accumulated in a foreign currency translation reserve account until the disposal of the net investment, until the disposal of that foreign operation. Means once the foreign operation disposed of, entire FCTR will be transferred to profit and loss account. On the disposal of NIFO, FCTR should be recognized as an income or expense in the same period in which the gain or loss on disposal is recognized. Means once the NIFO is disposed of, then entire FCTR will be transferred to profit and loss account as an income or expense. Understood? However, till now no question of this nature have been asked in exam, but if asked, it is very simple only. Apply the rules of NIFO, all asset or liability at closing exchange rate, all income and expense by using average rate, all equity will be translated by using which rate, transaction rate, exchange rate. Chalega? Yes sir. And any difference will not be transferred to PA, it will be accumulated in a special account known as FCTR. FCTR will be shown in the balance sheet under the head reserve and surplus. Correct. The next point is changes in the classification of foreign operation. Then quite possible that there may be reclassification required from E4 to NIFO or from NIFO to E4. If reclassification is done from integral foreign operation to non-integral foreign operation, so what AS11 says that from the date of reclassification, entire exchange difference will be accumulated in FCTR. Correct? So exchange difference should be translated or transferred to FCTR from the date of change. From the date of change. So whenever E4 become NIFO, so from the date of change, entire exchange difference will be accumulated in FCTR. However, from NIFO to EFO, if non-integral become integral, then in that case, what they want to say, कि from the date of change, entire exchange difference will be transferred to profit and loss account, and the FCTR closing balance, which is existing on the date of change, will remain in the balance sheet under what? Reserve and surplus. So the balance of FCTR will remain in the balance sheet till the date of disposal. An exchange difference should be transferred to PL account from the date of change. This is reclassification wala point, can be important for MCQs. This point can be important for MCQs. Chalega. The last point is forward exchange contract. Now forward exchange contract means what? Ki if you have done forward contract. Forward contract means what? Any contract which is settled in future date. So if you have done any forward contract which will be settled in future date, that is known as forward contract. And if the forward contract is done in foreign currency, that is known as forward exchange contract. Forward exchange contract, understood? So forward exchange contract means an agreement to exchange different currencies at a forward rate. Different currency at forward rate. So suppose you have entered into contract to buy $10,000 at rupees 80 right now, and this transaction will be settled in future, so that is known as forward exchange contract, correct? Yes sir. Now this transaction from accounting treatment point of view are of two types. If forward exchange contract entered for managing risk, for managing risk means sometime we enter into forward exchange contract to manage the risk, then what need to be done? Or sometime forward exchange contract entered for trading purpose or to earn some speculative gain. Speculative gain means for trading, for to earn some short term profit. So if the forward exchange contract entered for managing risk, then what need to be done? If the forward exchange contract entered for trading or speculation, then what need to be done? However, there are two questions has been given ICS study material. That question will be only asked. Means this is actually not a topic of CA inter level, this is a topic of CA final level. But in your ICS study material, they have given two questions. If they will ask that two question only. In the past also they have asked, so it means it can be repeated. So I will just inform you from that particular question only what will be the accounting treatment in these two cases, correct? So the first question is what? Question number 4. Rao Limited purchased a plant for US dollar 1 lakh on 1st Feb 2001, payable after 3 months. It means you can see there is a liability. There is a liability to pay 1 lakh dollar. 1 lakh dollar means now in any question if there is any foreign currency payable or foreign currency receivable, correct? Now it means it is a question of hedging. It means it is a question of hedging. So it means the forward exchange contract whatever has been entered for hedging purpose, for minimizing risk. Because can you see, if you have a payable in foreign currency and if the dollar rate increases in future, it means we need to pay higher amount. So that is the risk involved in this particular asset or liability. It is a liability right now. So there is a risk in this foreign currency payable. Yes sir. And therefore we are supposed to hedge that risk. Hedge means minimize that loss. Minimize that loss. For that purpose, company enter into a forward contract for 3 months at 49.15 per dollar. So they enter into forward contract to buy 1 lakh dollar at 49.15. Exchange rate per dollar on 1st Feb was 48.5. Means they have entered into a contract to buy 1 lakh dollar at 49.15. It means now whatever may be the price, they need to pay 49.15 per dollar, correct? Now it means right now the spot rate is 48.85. Means can I say they have entered into contract to pay 49.15. So how much premium they are paying? 49.15 minus 48.85 is equal to how much? 49.15 minus 48.85. So how much premium? Premium is 0.3 per dollar into 1 lakh. So you can see the total premium, which is total premium involved in this particular contract is what? 30,000. 30,000, understood? It means can I say in any case the loss cannot be more than this. So the loss is fixed. Means in simple word I will say we have taken an insurance policy to hedge the risk, and now we need to pay this much premium. Whatever may be the loss, we need to pay this much premium. Now loss beyond this will not be our loss. Means if the dollar rate become 50, then also we need to pay 49.15 only. It means this is known as premium on contract, and this premium contract will be amortized during the life of the contract. So life of the contract is what? 1st Feb 2001 to what? For 3 months. So 1st Feb, then March, then April. So 2 months fall in 1 year and 1 month fall in the next year. It means this will be amortized in 2:1 basis. Means in the first month contract period is 3 months, 2 months falling in the year ended 31st March 2001. So loss to be recognized for the year ended 31st March 2001 will be how much? 30,000 into 2 by 3, that is 20,000. And the balance loss will be recognized in the next year. Means for the year ended 31st March 2002 to 10,000 recognized in the next year, understood? So this is known as total loss. Total loss is nothing but premium on contract multiplied by the foreign currency units, means 1 lakh dollar. So total loss you need to find out. Total loss means what? You need to find out for premium per contract, premium on contract, that is nothing but forward rate minus spot rate. That will come 0.30. 0.30 into 1 lakh will come 30,000. This need to be amortized during the life of the contract. Understood? This is the first question. Second question which is given, that is for speculative to earn some short term profit, that is known as the forward exchange contract is held for the purpose of trading to earn some short term profit. In this case you can see Mr. A bought a forward contract for 3 months for 1 lakh dollar at 47.10 when the exchange rate was 47.02. You can see here there is no liability. In the previous question there was a foreign currency payable, means liability, but in this question there is no liability. So if there is no recognized asset, no recognized liability, means there is no foreign currency receivable, there is no foreign currency payable, it means it is a question of what? Held for the trading purpose. Means in this case forward exchange contract is only entered for trading purpose. Trading purpose means to gain some short term profit. So they have purchased at what price? 47.10. On 31st December when he closed his books of account, then $1 become 47.15. So you can see they have purchased at 47.10, but now the price is 47. Now the price on 31st January he decided to sell the contract at 47.18 as समझ लो कि when they have purchased the price was how much? On 1st December the price was, they have purchased at 47.10, correct, and on 31st December when he closed the books of account, then $1 become 47.15 and he actually sold the contract at 47.18. So you can see here there was a profit of how much? You can see here there was a profit of how much? 0.5 into 1 lakh. So 5,000 profit recognized in the first year, and here the profit of what? 0.3. So the into 1 lakh, so 3,000 profit recognized in the second year. The total profit is 8,000. The total profit is 8,000 that will be transferred to PL account. But the first year, because he closes the books of account on 31st 12, so we'll compare this price and this price, and you can see there is a profit of 0.5 per dollar into 1 lakh. 5,000 profit that will be transferred to profit and loss account. In the second year, you will compare 47.15 with 47.18. So there is a gain of 0.3 into 1 lakh, 3,000 profit transferred to profit and loss account. So whenever it is held for purpose of trading, then it will be always mark to market value. Mark to market value. So initially you purchased at 47.10. Then the price become 47.15. Then the price become 47.18 when it was actually sold. Now detailed discussion cannot be done here because it is actually a final level topic, but these two questions will come. I hope you have understood these two questions. Similar question come, now you can do it. Chalega. So I will say these questions are important because normally I have seen that this type of question they ask. So only if you revise these two questions and go to exam hall, you can attempt it. Okay sir? Yes sir. I hope you have understood all the points of this chapter is now covered. Disclosure you can do by your own. So all the points are covered. This was AS11 from my point of view. I hope you have understood. Balanced question you can do by your own. Chalega. So for this session this much only. We'll meet with one more accounting standard soon. Till then, bye bye, take care.